time for another interesting session that talks about the wealth managers' perspectives on investing into properties. What are the leading wealth managers advising their clients to do in these markets? And should their clients be investing in the real estate now? If so, then what kind and where? What is the advisory for South Mumbai specifically? Let's find out with this very interesting panel discussion, and we'd like to invite our panel members on the stage to please take their seats. Our panel host, Mr. Jayesh Karia, Head of Real Estate and Construction Sector, BSR and Associates, KPMG. May I further invite Mr. Amit Bhagat, CEO and MD, ASK Property Investment Advisors. Joining our esteemed panel, may I also invite Mr. Chintan Patel, Director, Real Estate, Hospitality and Industrial Advisory, Ernst & Young Private Limited. May I further invite Mr. Naresh Nadkarni, HDFC Property Ventures Limited. And our final speaker for the session, Mr. Pavan Swami, Managing Partner, Brookfield Advisory Services India Private Limited. So we're about to begin with another enriching session, and may I please request our panel host, Mr. Jayesh Karia, to start the proceedings of the discussion.
Thank you very much, Smart, for inviting the smart people on the desk. And they are obviously the deal makers and I would say the deal crackers, whatever I say. And I have on my extreme left Pavan. He is heading the Brookfield Advisory, and he has almost about 20 years of experience in the real estate market. So he's a hardcore, I would say, the real estate. Everybody knows him. Then next to him, we have Amit Bhagat. He has, again, more than 20 years of experience on the funding side, and now he is running the ASK fund very successfully, and then has been associated with real estate. So he has, again, significant experience. Then we have another big name, Naresh Nadkarni, and he has been, I would say, from the hardware to a hardcore to a kind of a soft side of it, the funding side, and he had been with the SDFC Realty for almost about 15 plus years, and then he has played significant roles both on the transaction sides, and now he's running the fund side. And then we have Chintan Patel again. Then he has gained more than 15 years of experience on the real estate side. He has been in the, I would say, the global markets, and he has been Australia, US, and all parts of the world. So he has seen the real estate market on this side, and now he's working on this side with E&Y. Myself, Jayesh Karia, I used to head real estate and construction practice within KPMG for the last 3 years, and I also have the significant experience in the real estate. Now, today we have the, I would say, the eminent panel over here, and we are going to deliberate on two things. One is obviously the investment opportunities in the real estate state per se, and particularly the South Mumbai market, that how do you actually look at the South Mumbai market vis-a-vis the other markets. And also, what are the, I would say, how they look up to both when they are looking at the transaction side or where they're looking at investing into the property, and how they are actually looking at in terms of the IR or how the deal should be considered, kind of thing. Before we get into kind of asking specific questions to my friends and the co-colleague panelists, just to give you a perspective on the real estate, and I'm sure you are more learned and more experienced than what I am, kind of thing. But it's like if you look at the kind of Kalbi, Ajbi, or Kalbi kind of thing, so the things have completely changed. The dynamics on the real estate sector has completely changed in the last 3 decades. That since 1980s, obviously, the real estate has been a kind of an opportunity for the developer. The kind of developments that have happened in the last 3 decades, both in terms of the regulatory funds, in terms of the funding, and even in terms of, I would say, the technology that is playing an important role, and also the demographics that are undergoing change. Like in 1980s, those days, obviously, when we talked about the real estate, it was always talked about real estate means residential and maybe a 5% kind of commercial. But if we look at the real estate, the market is completely dynamic. It's completely changed. The product is completely changed. What is being sold is not the real estate. What is being sold is the lifestyle kind of thing. And that's what I think the today's time. And even if you look at the kind of the consumption pattern, in those days, obviously, when people used to think about real estate, people used to think about that 840 or plus kind of thing. People think about owning a house, whereas today's population, when we about 60+% is between the range of 25 to 35, they are aspiring to actually buy the house at the age of 20 and 25 kind of thing. And that's the, I would say, in terms of the dynamics, in terms of, again, in the market which is evolving, that is, again, completely different market today. And look at the kind of the trend that has undergone change in terms of the investor's perspective. Obviously, real estate was being looked at a kind of what you call it as a very long-term or a kind of an ancestral property kind of things. Then people say that, okay, I have a property kind of thing. But in today's market, when the investors are looking at whether it is HNI or whether they're looking at the kind of private equity players when we have on the dais, obviously the horizon is completely changed. It's not a 10-year horizon, it's a 3-year, 5-year horizon kind of thing. Now, given that kind of, I would say, the dynamics that have undergone change and the kind of the pressure that is there on the sector, despite the sector being one of the important sector contributing to the GDP, I see that, yes, there are significant opportunities in the next decade to come, but at the same time, lot of innovations, and I would say the lot of, I would say the innovative thinking, both in terms of the product delivery or the product conceiving, and also in terms of the funding needs to be done. So with that background, let me just start with a kind of a question-answer session, and let's get the perspective of the august panelists. And let me just ask a kind of a common question to all of them, that how do they see in the next decade? I see that it's an opportunity for the next 10 decades, but let me just ask them that how do they see that as an opportunity in the real estate sector for the investors and the developers community? And at the same time, what are the, I would say, their suggestions in terms of the innovation that needs to be brought out in terms of the funding in the real estate sector? So maybe Amit, would you like to share?
We market, which is a luxury segment, which is South Mumbai. I feel that one innovation which can be worked out between you and developers, which can attract investors today, is if you compare a similar market which attracts investors, which is NCR, and you compare your South Mumbai market to that, you will notice that, and Mumbai should have proactively introduced that option before NCR. NCR has encouraged investors. South Mumbai has discouraged investors. And I'll say how it has done it. We have equity markets, and we know that if the secondary market is active, the primary market becomes active. And if primary market, you put restrictions that you can't sell till possession, your secondary market will automatically not be there, and then that means primary, you are discouraging investors. And I think that is one innovation which you can actively work with the developers. Every project which is being launched in South Mumbai, which is a luxury segment today, we are discouraging selling by the investor till the possession, which means you are discouraging investors and only asking about users to enter. Let us also understand that across the country, initially only 30% users, I mean, these are ballpark numbers, and numbers can vary from project and city to city. Initially, 30% users enter, the balance investor enters, and then gradually it is filled in by users. The moment you discourage investor by ensuring that he's locked in till the position, you are actually limiting your market. And I think that is one innovation which can be worked out if you deliberate with the developers, that if you have to encourage secondary market, a primary market, you have to encourage secondary market. By blocking secondary market, you will never be able to attract investors.
Naresh, what's your view?
Well, I will actually take, when I was talking to Ashokji when he came, he mentioned to me that we are not talking about South Bombay as Haji Ali South, but we are talking about island city. So I think, take it for an island city. And I would rather look at it as an investor into the project because that's what we have been doing. Yes, there have been definitely positives in Bombay as compared to market all India. If you have to just look at the risks that any investor will look at in the project while funding, one is the title, the other one is the approval, third is market, fourth is execution. I mean, these are the four risks which generally anybody looks at. And if we look at Bombay, Bombay is probably the best market in the country. If we have to look at the depth-wise, Bombay is the best market. If we are looking at island city, then I would say as compared to many other cities, including the suburbs, the situation of title is very good in the city because these are all old titles. I won't say they are clear titles, but I would say that there would be a large amount of transparency in the title. We know where there is a problem, it is known. Most of the title problem is known. The problem in this city today, and it will come in, is two aspects. One is the approvals, and the other one is the execution.
What's your thought on maybe from an innovation side, that what the developer or the investors can think of in terms of innovation?
Well, the developer will have to, of course, I mean, there is no innovation. It's a simple business trick is what today, if we have to come out of it and go ahead for the next 10 years, we have to be, first of all, we have to, again, on this side also look at the investors. You know, today the tendency is the developer wants investor till the time they get money. When it is coming to giving the money back to the investor, there is always a problem. And it has been clear across the board that we have seen developers, the developer has to understand first that, you know, the investor also has to make money. Of course, going forward now, if you are asking about the city, I would say the future would be in redevelopments in the city. The major thing is redevelopment. Within that, I think there has been some discussion on cluster development. That is another thing which one has to look at, where we have large chunk of land available. The equity required for the project is comparatively much lesser. So people would happily put out money, and the returns are also to the expectation. The investor today does not, I mean, the international investor even today does not expect a huge return. They realize that the expectation of return has to be standardized, or, you know, had to be, you know, lower than initially what they came with 30 and 35. But today the problem is they are facing problem even in taking the money back. So I think that is something that need to be improved over the next year.
Chintan, while you have been in different markets, in terms of innovation, do you think that as far as the island city is concerned, that one can think of a different model whereby there are two different business assets? One is the land is a separate business asset, and the superstructure is a different business assets. And therefore, in order to get more investors or more the kind of end users kind of thing, so if you split the title between the two and then give a long-term or a 30-year leasing and somebody gets in a 10-year, 5-year horizon kind of thing, so will that make an attractive proposition for the users? Like, given that today's population, as I said, that is fungible and they are moving from one city to other city, so they would not like to lock in their, I would say, the significant money. So they might say that I would like to remain invested for 10 years and then will get out because I'm not paying the price of the land and I'm getting the appreciation of the superstructure. So will that model, which is there prevalent in UK and other parts of the world, can be replicated here in India?
You know, am I audible? Okay, great. You know, I don't know if that model would truly really work in India, given the, you know, the cultural differences that we have, and people believe in owning. You know, even though they may start at a younger age, at a 25 or a 30, but the horizon is to be in long term. Probably people, if you see now, have started owning 2, 3, 4 homes, and then now it's become an investment. So it could be a play where if I invest and I don't intend to live in it, then I'm fine with flipping it. That model probably works, but then they don't want to sit in for 10 years, right? They want to wait till the construction ends and then probably flip it out once the prices have gone up. If I'm using it for living, then I would rather have it for a long term, probably see that, you know, the next generation enjoys it, or it becomes an investment vehicle. I think where some changes can be made, taking some global examples in places, I think all stakeholders involved, including the government, can play an important role. If I look at a 1.33 FSI, to begin with that, when I look at that with what's happening around the world and the high rises and the land parcels that I see, I think Mumbai, especially South Mumbai, can do much better if FSI norms were improved. Second thing is, from a technology standpoint, a lot of things have changed. High-rise construction and everything has significantly changed. The time to market. You know, you construct something, and if that's going to take you 3 years or 4 years to construct, for a developer, that adds a lot of cost. For an investor, if I came in at the start of the project, and if I have no cash flows coming on or limited cash flows coming for the first couple of years, that impacts my IRR. So again, a play has to be done where technology plays a role. From an exit standpoint for investors, you know, if REITs, you know, real estate investment trusts, so where part of
I'm going to ask a specific question to you all on the REITs kind of thing.
Okay, so I'll just kind of wait for people to kind of add on that. But I think those, if you look at from an innovative standpoint, from a technology standpoint, from a financing standpoint, right? If you look at end user financing schemes, 2080 became an innovative scheme that started in this cycle. However, government, for its obvious reasons, has put a clamp on it, saying that this is not something that is in favor of end users. So I think unless people get innovative, things will not move at a pace which is going to be attractive for investors, for developers, and for end users. So to your starting question, does this for the next 10 years an attractive opportunity real estate? Absolutely. It will continue to be. This is one thing that is in scarcity, right? If you look at an island city, land is scarce, but everybody wants to be over here. And this is, even in mature markets, if I look at a New York, a Hong Kong, a London, a Tokyo, it will continue to happen. Those markets have been mature, their prices have been higher than Mumbai, but people still want to be part of that game.
Pawan, what's your thought? Given the kind of the prices have touched the peak, do you think that there is a need for innovating in terms of pricing model, which makes the housing more affordable?
So I have some strong views. First of all, I think I think it's important to share that from a research standpoint, the maximum amount of private equity money that has come into this country has come into Bombay, and the maximum amount of private equity money in Bombay that has come into the island city. So it's attracted the maximum amount of private equity, first of all. Secondly, I think the government being not as proactive, and someone on the previous panel said that, has caused a lot of pain to the developers, and that has escalated to the investors as well. The reason I say that is, there's a lot of questions around execution of a lot of developers, which may be right, may be wrong, but a lot of that delay has happened as a result of the approvals coming late. Now, as a result of approvals coming late, the developer has stopped pouring concrete because he has no idea on any line of sight on when the approvals are going to come. So even if he can execute quicker, he's not doing it. And that effectively has an impact on the investor. So we went, if I can take a little bit of background, I think we went in India from a situation where all of you used to help developers buy land from pre-sales. So he used to actually pre-sell apartments, buy the land, and then go ahead with the construction cycle, to when private equity came, NBFC came, other family offices came and started giving structured money to developers. I think today, with where we are in terms of the curve of the market, which is that private equity liquidity has dried up. There's very few friends like Amit, who are doing pure equity. And when I mean pure equity, the fund comes in, they play the upside risk or the downside risk. Everybody wants to give structured debt at 2021. In 2005, 2006, everybody came and they said, India is the greatest story, 1.2 billion people, 300 million people, at below the age of 40, great middle class market. So they didn't actually see the dynamics of the real estate, and let's say just start putting money in 100-acre townships, right? That was a problem. Luckily, South Bombay couldn't do 100-acre townships, so we didn't see too much of that here. To specifically answer your question, I think I think where we are in the curve over the next 2 or 3 years, there's not too much of an option for innovation. I think unless it is driven top down by the government, there is very limited stuff that either the investors or the developers can actually do, and that actually increases the role that this group sitting here plays. because in between there were a lot of other opportunities for the developer to go back, but now he's come back to the same old gross bottom of saying I need to sell at the right price. The best way for me to finance myself is to go and see if I can sell more stock, create schemes for yourself, for the end user, for the investor. Like Naresh pointed out, I think Naresh or Chintan pointed out, at the end of the day, this whole structure where you're going to loosen up investors, for investors to actually come in, will happen in the market. I think developers are saying you will not be allowed to sell till the end. That will change. It will get diluted. That will be driven by the market, not really by the developers or the investors.
Pawan, you made a very interesting point in terms of the investor's point of view. It is a equity versus the structured financing, and we have the two eminent, I would say, the investors over here. And let me just check with Amit Bhagat. Amit has been actually investing a lot in terms of equity, whereas I think I'm getting a diverse view from Naresh in terms of investing. So let's hear from both of them the perspective, why equity and why structured debt kind of thing. So Amit, would you like to just share your perspective between equity and structured debt? And then we will check with Naresh on that.
Yeah, in fact, our view is that if a project makes money, both investor and developer will make money. Developer is not going to give money from his other project to the investor in some other project. And in India, if you look at the private equity, it is all project level private equity investments. 90% of the players today are doing only structured, assuming that the first money will come to them and some 22 to 24% returns will come to them. That I think is not private equity. It's kind of an NBFC. So there's no difference between an NBFC and a private equity who's doing a structured debt. NBFC also does not have that surfacey where he can go and recover the money, which is available, that tool is available with the banks. Only housing finance companies have that tool. So structured is a misnomer. People came with equity, but they went to the wrong product, as Pawan has pointed out. They went to townships, SEZs. Now when they are trying to do equity, they realize that they don't have the understanding to do equity, so they started doing structured. I strongly feel that if you are not willing to take the downside risk, then you will not get the upside. So you have to be an equity player in this country to make money, but provided you have an excellent understanding about the real estate investing in this country. Look at South Mumbai. We have analyzed almost a dozen deals in the last 3 years. South Mumbai will not give you a deal on a platter. It's a land scarce island where you will get deals with complications, deals with very high value. When you will start analyzing them on an Excel sheet, it will not be feasible. And in hindsight, I don't regret that I have not done a deal in the last 3 years in Mumbai, because if I go back and revisit every deal which we analyzed, we realized that it was coming at a price at which it was not feasible. Secondly,
just hold on, Amit. I think maybe Pawan has a different view on the South Mumbai. Maybe, would you like to? For a quick 30 seconds.
Yeah, sure. So I really don't have a different view. I just think that I think there are opportunities there,
yeah.
And I think you need to go and get. The important thing is, I think when structured people are, and Naresh is probably more right to answer this, but when the structured people are actually lending to developers in South Bombay, they are lending not just taking the cash flows of that project or that site. So it's got to be somebody who's got a portfolio of projects around Bombay,
yeah.
Who's got a site in Bombay, in South Bombay, which is clean. He'll take money there because he's still going to make a lot of money, take that money out and go put money in a Borivali, Kandivali kind of site. It's
Great.
not, it doesn't need money for that.
Great. Naresh, what's your view on the structured versus equity? I believe you have a different view.
Yeah, see, first we have to start with that the investors are here to make money. And, the idea is to optimize the returns. Let's face it. If investors are allowed to buy and trade in flats, they would rather do it because that is where the maximum returns lie. Second is the notion of IRR vis-a-vis equity multiple. Now, if we are talking about Mumbai, I have spoken to almost all the developers. Today, all the developers in Bombay look at only multiple. Nobody is looking at IRR. The reason being, when you buy the land today, you have virtually no hang on when can the project be started. As a fundamental thing, what Amit says is absolutely right. One, if you are a private equity player, you have to create and take a risk of equity. And that is where your returns are going to be optimal. But when today an investor is buying a land, today the developer the operator who is supposed to know everything about it, for which he gets the premium, for which he gets additional money, himself does not know when he is going to get the approvals. And we have
So you're saying that the structured is better because the risk is
structure becomes
lesser?
far better.
Or you see that the developer is running
In the
larger
present
risk?
situation,
Yeah.
present situation where we have so many factors which are beyond even a developer, it becomes, but when we say structured again,
Yeah.
we are not talking about structure of 20, 22, 25%. It doesn't work. Nobody can do business where he has a debt of 25% sitting on his head for day one.
So that was my precise question. So when you're talking about structured deal and the
Actually-
expectation is 22% IRR kind of thing and plus upside, so does it really work for
It
the
won't
investors?
work.
Yeah.
On a long term, I mean, somebody can make money, taking an opportunistic view, and probably one or two cases they may make it. On a longer term, on a sustainable basis, a 25% return on a fixed return basis will not work.
Okay.
I think what we have seen is anywhere a structured debt of around 18 to 19%, around 18% in today's market. I mean, it has to vary.
Okay.
In today's
Is
market,
still
around
not a higher
18%.
side? It's
Sorry?
still not on a high side?
Well, but again, I mean, if we are coming
given
at
the returns that are going
if
down?
we are, no, but if today the project loan is available at 14%,
Yeah.
a loan kind of MES funding at 18% is not very high. I mean, one has to look at that way. Today the project funding is available at 14, 15%. A AAA developer gets 13.5% today. Now, I'm not getting into that, getting ADF at individual rate and all that maneuvering I'm not talking about. But what is the rate today is around 14%. So that way 18% and take a equity kicker along with it so that you have at least some portion of it covered and where you have a priority over a developer. I mean, that is something, and nowadays where 70-80% has been put in by the investor, I mean the incentive for a developer also to work has to be there, So
Okay, let me turn around to Chintan and just ask a very interesting question. That obviously we have seen the US market, why it has actually fallen down. It's because of the leveraging. In India, we don't leverage too much. So what do you think that the leveraging is something that the investors, especially at the retail investors or the HNIs, should look at it in terms of mortgaging their existing property, taking money on top of it, and then again reinvesting again then on the leveraging kind of thing? Do you think that's a model that one can think of will work as far as the India is concerned?
I think in the Indian market, the slightly different dynamics are first, the component of what the value is, right? And what percentage of that is getting financed through debt.
Yeah.
And if that percentage is significantly lower, so what happened in the US, again, I was there through the 2 cycles of US
Correct.
that happened over there. And I agree with you, the leverage of going up to 90, 95, 100, negative, reverse mortgage, you name
Yes,
all of
reverse-
those
all kind of
fancy
mortgage.
terms,
Yeah,
right? At
absolutely.
the end of it, by the end of it, you were significantly over leveraged. In a market where the valuation continues to go up, the music continues to go on, the world does not end. Yeah. But when your values start going below what you had paid for, at some point it becomes that my EMI or my monthly payment is significantly higher than what I would have gotten from a rental or from buying the property today, right? And that is where I think the flip side is India so far has not gone through that. Okay. Unless there is a method to the madness where people pay only effectively, and I don't want to get into specifics of it, in this panel, but effectively if you're leveraging yourself at 50, 60%, depending upon how you made your payment, right, then it's not a bad scenario. And if you do that 2, 3, 4 times, the problem with India, part of it is also the yield that you get on your investment. Yeah. If you're talking in a Mumbai, when you're talking about a 1.5 to 2% yield, when my cost of debt to get that is 11%, I'm in a significant disadvantage. When I look at the same thing in the US, if my yield is 5% to 6%, but my cost of debt is also 5 to 6%.
5 to 6%,
So
yeah.
at the end of the day, whatever my EMI is met by my mortgage. So how much can I default on? Unless, as what I said, I overpaid for it, I over leverage, then it does not make sense. But at a normal leverage level, I should be able to meet my EMI through my rental, which in India it's not going to happen. And that's where the biggest disparity
So,
is.
no, that's one thing. But do you favor or you don't favor? Because I have a different viewpoint from Amit in terms of leveraging and using the mortgage market.
No, I think as long as you can afford it and that is within your band and
Okay.
rentals can accommodate for it, then it's a same thing because over a period of time, if my rental pays my EMI, my principal is also getting
Yeah,
paid for.
that's true.
So over a period of time, it's a good thing. But if I cannot, if I buy 3 or 4 properties and my rentals is not going to match that, how will I get the cash flow to match that? And that's what people should think about before doing. Historically in India, appreciation has helped that. Will it continue to happen in future is the question that you need to answer before doing that.
Amit, I have a big question on that also. So before we get in mortgaging, because people have been investing in the island city at the celebrate rate of 25,000 to 1,20,000 as an investor. So I have my own doubts that whether they will get 2x kind of money that what they invest kind of thing. And obviously in the mortgaging, your thoughts.
If you look at the delivery in the last 5-7 years, the delivery from concept to conclusion is a 5 to 7 year story for large projects in South Mumbai. I think Naresh was mentioning that if you examine all the mills which were auctioned from 2005, you will see only one has been delivered and others are not delivered. So if that continues and we are back in the GDP cycle of 7% plus, you will see appreciation. As a user, you don't see leverage because you know your limits and you buy. I am a strong believer of leverage. If you examine any real estate project, and probably Naresh can vouch for it, because the construction finance from the largest lender is available at 13 and 14% today. So if you examine any EBITDA margin of any project in this country, it is upward of 20%. And if it is upward of 20%, any individual customer who has leveraged and has entered at the beginning of the project, and if you look at the price movement in a project, in the beginning of the project to the completion, there is a 30% gap which exists even now actually. A 20,000 rupee or a 30,000 rupee project launched will at completion be a minimum of 45,000 rupees. So if you are leveraging, and if that delivery time is somehow can be predicted as it can be predicted in Bangalore, Pune, NCR or other locations, leverage is a wonderful play.